But is the national debt a danger to the economy, in your view?
In the long run, the U.S. is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path, and that just means that the debt is growing faster than the economy.
I have the sense this worries you very much.
Over the long run, of course it does.
Coming up on today's show, stocks finish higher, the melt-up in AI stocks, which ones could be next, the worst destroyers of wealth, regional bank troubles, Trump and Biden spend a romantic weekend together in the woods, the China meltdown, and the empire strikes back against Islamic militants in the Middle East. Hey, what's up guys? Hope you're doing well here. Welcome back to the Click Capital Daily Market Show. Bit of a quiet Tuesday on Wall Street, just slightly rising. It was actually the Super 6 stocks that pulled back the most today. With NVDA having a rare down day, Super Microcomputer was down. However, did a huge buy the dip. This thing is screaming to new highs again. We got a big bounce in Chinese stocks today. Still got some troubles in regional banks. And so while we've got the S&P 500 just sitting below all-time highs at 5,000, a lot of people don't realize underneath the hood, most stocks have already been having a correction all year. What you're looking at in the blue line here is the percentage of stocks above their 50-day average, peaking out about 91% to start the year and continuing to fall. Here we are just at 57% today, while the S&P 500 is still holding up there. So we've got a bit of a divergence going on with Brett. Another interesting dynamic happening in the stock market right now is implied correlations are hovering near record lows, currently just 14%. Basically, that means there's a lot of dispersion in the stock market. We've got some big stocks like NVIDIA, Supermicro, Meta, other things like that rip into highs. Then we've got a lot of stocks actually falling. And just zooming back out on this chart here, that can be a sign of a pending correction. We saw back in early 2020, got down to similar levels where we are now. And then when we got that COVID crash, like we see in all crashes, correlations moved towards 1. So it got up to over 80% at the height of the COVID bear market. And that's because the huge liquidity drain on the market, everything gets sold and starts acting like a big school of fish. And we saw that in the great financial crisis. 2007, implied correlations were pretty low, then started climbing and then really spiked up in late 2008, super high, 96%. We've also got the skew index, pretty elevated here. That's the price of out-of-the-money put options on the S&P 500. You could think of that as tail risk insurance. Even though we've got the VIX super low at 13, if you want to insure your portfolio for crashes, you're going to have to pay up. And typically, this rises before the market corrects, like we saw in 2021. And then in 2022, it rolls over. So you could kind of think of it like flood insurance. Before the flood, the price to insure it is high. Then when we get the flood, the event has happened, then the price to insure it is really low. Again, another pattern we saw in 2007 going into 2008. But we're even higher than that now, getting back to those heights in 2021. That's right when the market peaked out, mid-21 in terms of breadth. The S&P 500 kept going up to November, but we had a big divergence in breadth, and the price of out-of-the-money put options was already starting to come down as well. And there's the S&P 500 there, so we've got a lot of parabolic momentum here. A lot of people are thinking we're going to pull back in February because we got that seasonality. However, just because of that divergence in breadth and price of skew options doesn't mean we can't go a little higher. I've got a feeling we could kiss 500, maybe a little bit above before we get a pullback. However, it's very hard to tell because there's just so much momentum in this market. But stick with me throughout this video, and we'll come back to the charts later on and I'll show you what else I'm seeing out there. First, just a little bit about my video I did on Friday night, look into clean energy. Definitely sparked a bit of lively discussion in the comments section, and I appreciate we've all got different views and opinions on this. I understand there's a healthy distrust of our leaders, which I understand, but the good thing is we can have a healthy discussion and debate and disagree and not have to cut each other's heads off like some other countries. And that's one of our positive traits. Here in the freedom-loving, democracy-believing West, we don't all have to agree on the same things. And don't get me wrong, even though I'm a believer in clean energy and human-caused climate change and the benefits of going clean and green, I don't think the politicians can just tax us at will, nor should they destroy farmers, which I think is going to be a very important sector for many decades going forward. And if anything, these clean energy policies is providing a strong structural tailwind for the farming sector. And that's why I've got some long-term strategic investments in this sector, which is something I go into in my online course due out on Monday night next week, New York Eastern Standard Time, when I do the daily show. I'll let you know why farming is an area I'm personally invested in, and I'll let you know the specific investments I have in that sector that I think are going to hugely benefit from these big structural changes already underway in our society. And that's just one of many topics I cover in this course. I've been working on it for over 6 months. A lot of people have requested me to do a course. It's over 12 hours in total length, 25 different modules. And if you like this daily show, then you're going to love my course. There's a lot of content, topics, and strategies I cover in there that I've never talked about on the show. And so whether you're a new or experienced trader investor, you're going to find a lot of value in my online course, covering everything from financial markets history, the biggest bubbles and crashes, how markets really work, in-depth teaching of technical and fundamental analysis, along with valuation and economic analysis. I'll also share with you all my long-term investments that I personally have, along with going into deep detail of all my active trading and investing strategies. And so I'm really excited to bring this to you guys next week, and I'll be offering a discount for the first week to all you guys on here. And I think you're going to find a lot of value in my course that I've named Trading, Investing and Wealth. Master the markets to achieve your independence. So stay tuned to that one, and make sure you're subscribed to the Click Capital channel here on YouTube if you haven't already. So just getting back into the daily show, it's really been semis leading the way this year. Like a bull out of the gate. However, there's quite a bit of a pullback today, with the rest of the market putting in a pretty solid day. We saw that in REITs. Industrials are still breaking out to all-time highs, and healthcare the best performing defensive sector. And it's starting to feel like we could be getting into that speculative mania that we always see in late stage moves or markets. We're just looking at the price action of NVDA and some others like Supermicro. With NVDA, already a huge company, up over 40% just in the first month of this year alone. Adding over $500 billion in market cap in just 6 weeks, almost the same value as Tesla. And just looking on the daily chart of NVIDIA, it's got a classic hanging man candle there, which could be the sign of a little short-term top. However, I wouldn't rule it out that we keep melting up and hit $700 for the first time ever, just getting shy of it today at $697.50. And the move up in Supermicro, even more impressive in percentage terms. Starting the year at $280 a share, it's already up 143% on huge volume as well. They did come in with a blowout earnings, but these type of moves are just not sustainable. However, that doesn't mean I would short it here. Markets can do crazy things, could go into a huge type squeeze and even see $1,000 before it pops. And in my opinion, any position in this one's risky, long or short. Being long, you're vulnerable to a big rug pull, and being short, that's like stepping in front of a steam train. Absolutely insane move in these big stocks. However, just looking at AMD, it potentially looks to be putting in a topping pattern here. We can clearly see momentum stalling out, getting a bit of a divergence on my indicators, and it's not that far above its 50-day VWAP. And apart from regional banks, the semiconductor sector was the weakest today, with it too looking like AMD, maybe starting to look a little technically exhausted here. We've got some banks like JP Morgan saying, buy Broadcom. That's the biggest AI chip play after NVIDIA, saying its stock offers an attractive opportunity. They've got an overweight rating on it, with a price target over $1,500 now. And this is not really a stock too many people talk about, and I think it would surprise a lot of people to know that its market cap's already over $500 billion. But it too is looking a little tight on the chart there. But what's not looking tight on the chart, and a favorite over at Reddit, is Palantir. Just posted a good quarter, and then we've got some other analysts like Wedbush saying the company's an undiscovered gem of the AI boom. That's Dan Ives raising his target on the stock to $30. They said their revenue increased 20% last quarter, beating street estimates, and a lot of people are really optimistic on the long-term story of Palantir because of their defense and intelligence work with the US and international governments, which is likely to remain of strategic national importance for the foreseeable future. And there's a look on the daily chart, ripping up over 30% today on a huge 419 million shares traded, now coming in at a market cap $47.5 billion. And just looking on the monthly chart, still got a bit of work before we get back to those crazy 2021 highs at $45 a share. That was a bull right out of the gate on its IPO. Got slammed in 2022, getting down to under $6 a share. Really bounced back last year, and technically looks to be in a pretty strong uptrend here. So it could be the case we see a bit of a rotation out of NVIDIA, AMD, and maybe into some of these other AI stocks like Palantir over the coming days and weeks. We'll be keeping an eye on it, as it is the big dominant theme in the market at the moment, creating immense wealth for a lot of investors out there. However, who's not creating immense wealth for investors is Cathie Wood and her ARK Invest fund management firm, with her collection of ETFs having destroyed over $14 billion in wealth over the past decade. Somehow the media still parades her around like some investing guru, and her whole thing is supposed to be investing in innovation, the future, what's changing society. Well, she's totally missed it on AI, with her flagship fund, ARK Innovation, still down over 70% from those 2021 highs, when a lot of people will call on her the new Warren Buffett. However, the normally conservative Morningstar actually called her out. On the top of their list of the top 10 wealth-destroying fund families over the past 10 years, with ARK ETF Trust estimated to destroy over $14 billion. And that's not just the loss in the ETF. That's because she does a great job at sucking a lot of people in when price is ripping, appearing on national TV and media. And so we see this every time in every bull market. A lot of people end up investing in here, then end up selling down here, as they're simply guided by price, sentiment, and headlines. And so in my opinion, she deserves an award for being the best marketer in the game, because she still somehow gets a lot of media spotlight, even though her firm's been one of the biggest wealth-destroying fund families to ever exist. Moving on to commodities, we got increasing action happening in the Middle East, and it's kind of a bit of a tug-of-war in the oil market, with plenty of supply coming out of non-OPEC countries. However, still the risk that supply from the Middle East, which still gives the world over half of its crude, could be choked, especially if we see Iran dial it up in response to the US retaliatory strikes over the weekend, with some like Occidental CEO saying oversupply is keeping prices low, but the situation is about to flip. That's Vicky Hollub saying oversupply will soon ease and the market will be undersupplied, sending prices upwards. Even Goldman Sachs analysts saying oil could be in a new super cycle. But contrasting that, we've got research out of Bank of America saying the rate of oil demand growth has peaked for good, and they expect it to slow in coming years as energy technology is becoming more efficient, which will temper total oil usage. But for now, the world still needs a lot of the dirty stuff, and it could get worse before it gets better. Still really yet to see how Iran are going to respond to the huge amount of US strikes we saw over the weekend, with them saying it's a strategic mistake, with the US military saying this is just the beginning of its response, so there's more to come. After they've already attacked targets in Iraq, Syria, and Yemen, things just keep heating up in this region over there. The markets are not really pricing in a tail risk as of yet. So if it were to spill over, you could expect a big repricing across market. And so we have seen Iran before attack back at US bases directly instead of instructing their militant subsidiaries around the region to do it. That was after Trump took out Iran's number 2 man, their military chief. They fired back on a US base. And can you just imagine if Iran really wanted to dial it up and directly target the approximate dozen military bases the US Western Alliance operates in the region as kind of a message saying get the heck out of here? Biden could really be put in a tight spot on how to respond to something like that, likely oil shooting upwards, and have to make a big strategic decision whether to hold ground in the Middle East or pull back, which could look really weak as well. So a direct major conflict with Iran has always been on the cards for a couple of decades now. However, right this moment, it's escalating as much as we've ever seen it and could reach a boiling point before it resolves. So we'll just have to wait and see how Iran responds to this. Likely going to keep instructing their militant subsidiaries all around the region to keep attacking our cargo and shipping vessels, probably US military bases as well, and hopefully that doesn't come at a cost of any more lives. Otherwise the US and its alliance is forced to respond to not be seen as weak. And this is inspiring others like Somali pirates to dial it up as well, attacking ships and increase piracy and creating all these little hotspots around the world that the West continually has to put out. That's why we got shipping rates breaking out again today. It's a new multi-month high, up over 7% in a strong uptrend, and this is inflationary and a leading indicator, because if you think about the primary cost inputs into most goods and services, a lot of them have to be shipped. Shipping rates are going up, insurance rates are going up. If oil were to follow, then that's really not good for the inflation narrative currently taking hold in markets. Maybe that's why we've got Buffett buying the dip again in his favorite name, Occidental, adding over $250 million to his stake in recent days, still trading under $60 a share, and we saw him do the same thing back in mid last year, around the same levels. He's buying the dip in this name, obviously sees a lot of value there and wants some long exposure to oil in his portfolio. We've got other areas of worry in the market with the reignition of issues in the regional banking sector. New York Community Bank Corp, with its shares getting slammed down, surprising the market a week ago, with a dividend cut and a $500 million increase in its loan loss reserves. And it could be just a case of the issues in the commercial real estate market coming home to roost, with regional banks highly exposed to the sector. And we can just see that in the market's response to that news, sending shares down 60% just in the last week alone, down another 22% today. That's why we got the regional banking sector, the worst performing sector today. Technicals here don't look too good, and I can imagine if we get news of another bank reporting similar situation, these worries in the regional banking sector could spill over to the broader market and help cause a bit more of a correction in the indices. And so we heard from Jay Powell on 60 Minutes on Sunday night. It's obvious he thinks we're still going to get some more hot economic data like we've been seeing over the last month, most recently with the jobs report last Friday, almost doubling expectations in terms of new jobs created last month. And so he really pushed back on the narrative the market had become convinced that he was going to start cutting in March. And just reading in between the lines, you can just tell that in my opinion, he's worried about inflation coming back again. He's not ready to declare victory on it. Says it should be done, hopes it's done, but he doesn't want to spook the market. He knows what's out there. He doesn't want to make the mistake the central bank made in the 70s. When they saw inflation coming down, they cut too early and helped cause a second and third higher waves higher. You can see that in Fed Fund futures, just ever so slightly increasing their chance they're going to stay on hold even in May. Market still thinks the rates are coming just so far this year. Just continually pushing back those dates when they think Jay's going to start. See that in the price action. Fed's sensitive 2-year yield holding ground at 420, breaking out on Monday to a new multi-week high. Same with the 10-year holding ground above 4%. And it's going to be very interesting to see how all this unfolds in this important presidential election year. And just joking, guys, Trump and Biden didn't really spend a romantic weekend together in the woods. I just thought this AI-generated image was pretty funny. And there were some politicians on Twitter actually saying, look how authentic and real these images are. They're so convincing. However, I think we're more likely to actually see pigs fly before we see these two broing it out in the woods together over a weekend. But this is going to be one of the big stories this year. Could really get markets moving. The VIX Futures October contract has already priced in a huge spike in volatility for those options expiring in November. There's a lot could happen between now and then. And if Trump does make it back in office, that could have huge effects on foreign policy with what's going on in the Middle East and Ukraine. Domestic energy and plenty more industries will be affected by it. And there's a look at the latest odds compiled from a collection of sports betting sites. And bookmakers are pretty good at pricing the future, normally get it right. Currently, they've got Trump almost 50% odds of winning versus Biden at 35%. And somehow they've still got Michelle Obama at 6.3%, even though she has said many times she never wants to be president. So we're keeping an eye on this one as we move closer to this important date this year and see how it affects markets. Big thing we've been seeing all over the news wires over the last week is the meltdown of Chinese stocks, with the biggest Chinese hawk out there, fund manager Cole Bass, saying China's facing the US financial crisis on steroids as the real estate market collapses. Also seen other headlines like China's chances of staging an economic rebound this year look slim. Beijing hasn't been able to stop foreign investors from fleeing China's stock market, and even though we got a pretty good rip today, the general public sentiment is they're still done for. They're cooked, it's not coming back, and continues to be probably the most hated asset class across global financial markets. However, not for me. I love playing the contrarian when it feels right, and just looking at this chart of the largest Chinese ETF in the market, FXI, that's looking like strong technical signs of a bottom here. Got this bullish divergence. I can see my institutional buying percentage indicator has been firing off green for a couple of months now. Got these big volume thrusts coming up, huge 5.7% today. Same deal looking at their local China 50 index, their Chinese ETF, big volume thrust, and one of my top 10 ETF picks for the year, Chinese small cap ETF, ECNS, and my favorite stock in the sector, Alibaba. You guys remember back down here, we're trading below $70 a share. I said that was really good value. For a buy, we had a lot of technical indicators. You can see price kept gapping down, just kept being hold and bid, and here we are today, thrusting up it as well, looking like we're going to hit $80 a share soon. So I wouldn't be surprised if we have seen a bottom in the Chinese stock market at this time of peak pessimism across media and throughout online communities. And there's a look at clean energy as well, having a pretty good day. The Invesco Clean Energy ETF up 4.2%. Not seeing these huge volume thrusts like we're seeing in China, but we are getting some signs of technical bottom. Bit of a bullish divergence on my DSI, some institutional buying, and some areas just remain really oversold like lithium. Doesn't look like a strong bottom just yet, no divergence, but we are really technically oversold here. And that's thanks to the granddaddy of them all, Tesla, which is trying to hold ground here at $180 a share. But I don't know, it's looking pretty weak here. It looks to be sliding. Not willing to call a bottom on Tesla just yet here. Moving on to economic data, didn't get really much out today. Still got retail sales in the Eurozone contracting, and we don't really have much out this week. Bit of a quiet week on the economic calendar, with jobless claims like we get every Thursday being their only real standout. Fear and greed index still holding ground just below the extreme greed zone, and corporate insiders stepping up their selling once again with only a marginal increase in their buying. There's a look at volatility, stuck in this range again today, falling back down just above 13. And same deal with volatility risk premium, which is pretty interesting. It's a premium of implied volatility over realized, just 1.4. Last time we saw that fall was back in late October to November, just as the market was bottoming. Option dealers dropped their implied volatilities. And so there's a big kind of bearish thesis out there on Twitter. A lot of people convinced we're pulling back on the S&P this month because of that seasonality. Everything's too stretched, technically overbought, which is true. However, just like I showed you on 50-day Brett, market's already been pulling back this whole month. looking at all stocks, just those mega cap tech really holding the S&P up. But this is an interesting dynamic in VRP, because this is telling me that maybe we're not going to have a big correction. And like you see in markets, they can correct in price, time, or a bit of both. And so maybe we don't get that big price correction, but maybe just a bit of correction in time when the S&P just kind of flutters along sideways for a month or so through February and March before finding its feet again. And that's kind of what it looks like to me, just looking at the volatility risk premium here. Same with high yield bonds, just kind of consolidating here, holding ground, even though we've got a bit of a breakout in the dollar, which is typically a negative for the stocks. And there's Bitcoin, just tracking sideways as well. We've got a lot of major markets in consolidation patterns at the moment. Most notable, gold futures, hugging the 50-day VWAP, constantly trading just below its all-time highs. International stock indices, still mostly in an uptrend, just consolidating, holding ground as well. And there's a look at the spread of equal weight S&P versus the normal S&P. You can just see that huge underperformance of Brett so far this year, and inflation expectations just kind of holding ground as well. Winning sector today was airline jets, up 3.3%, causing the whole transport sector to break out as well, along with a continued rally in healthcare stocks. So look at the cannabis ETF. This is trading like the DEA is about to come out any day and announce they're rescheduling cannabis from 1 to 3, which could give it a further pop to the upside, and hopefully keep rallying into November with more federal legalization hopefully on the way. There's a look at Apple, holding ground there, and this has been a weakest performer of the big guys for a while now. However, come back to the channel tomorrow. I'm going to show you a bit about their latest product, the Apple Vision Pro, which has just been released to the market. It's getting some pretty positive reviews from the tech blogging community, and we'll take a look at whether that's enough to kind of rescue the stock sediment and help drive a bit of growth again. There's Microsoft looking a little tired as well. Alphabet trying to regain lost ground after its earnings last week. Amazon holding ground, and same with Meta after its huge blowout quarter on Friday. There's a look at the spread that I've been long on BlackRock's Bitcoin ETF and short Coinbase, as my theory is that people are much more likely to get exposure to Bitcoin through going through Coinbase, with BlackRock being a safer third-party custodian, not to mention way cheaper fees than Coinbase as well. So far, that looks to be working pretty good. And JP Morgan, the biggest bank, kind of just holding ground there, consolidating. Looks like it's just waiting to see what happens in this regional sector problem, whether that spills over to the banking system and broader market as a whole. That's still possible and yet to be seen. But that pretty much sums it up for today, guys. Thanks very much for tuning in. If you enjoyed this video and found some value, please hit that like button. And if you haven't already, subscribe to this channel as well, because starting next week, I'll be back to my regular scheduled daily show 5 days a week after market close, when I upload videos around 7 p.m. Eastern Standard Time. A few hours after market close, I'll keep you up to date on everything that's happening, my thoughts, analysis, what the major trends are, opportunities and risks, and I'll also let you know how you can get access to my first ever online course, which many people have requested from me for months now. And like I said, this is why I haven't been able to do 5 daily shows for a while now, as I've been pouring so much time into this, and just wanted to share all of my knowledge, experience, techniques, and strategies with you guys in a comprehensive, in-depth course that will be due out on Monday night. So I'm really excited to share that with you guys. That's all for now, and I'll see you again tomorrow night for the daily show. Cheers.